Everyone, welcome to SumZero. Today we're chatting with Nathan Montone from M31 Capital, and we are going to be talking about Web 3.0 and some of the frontier elements of blockchain technology. Nathan is a Columbia University graduate.
Now I know what this is.
Sorry, if everyone can just kind of mute themselves, that'd be helpful. But he's got a background in VC. He's an angel investor. He's got a track record of success investing in groundbreaking technologies across the blockchain industry. He's invested in over 100 startups that are now collectively worth billions of dollars. And he's been an early advisor and backer to some of the more successful blockchain and crypto asset projects, including Helium, Filecoin, LivePeer, Thorchain, and others. So Nathan, with that, welcome to SumZero. It's great to chat with you, and you've obviously got a really interesting background, and your partner, as I understand, was the former Bridgewater Associates COO, and he's also kind of obviously taken an interest in blockchain. So you guys have built, M31, to be kind of, I think one of the evangelists of all this technology. I think for most of the SumZero community, Web 3.0 is a little bit of a buzzword, and that there's definitely some very promising, exciting elements to it. But I think for a lot of folks, both in and outside of the SumZero community and the professional investor community, trying to assess like what's real and what's kind of hocus pocus is a little challenging. There's not maybe a great deal of transparency around the teams and maybe the exact level of adoption of some of these technologies. So I think maybe what we should do is first, it'd be great to hear a little bit about your fund and your overall philosophy around why Web3 and kind of what uniquely positions you to sort of be a steward of capital in this particular industry. But then I'd love to talk about specific blockchains and protocols that you really think have a bright future ahead. So first, maybe just give us a background on yourself and M31. Would love to start with that, and we can take it from there.
Yeah, sure. First of all, thanks for having me on. I'm looking forward to the conversation, and happy to see such a good turnout for a conversation on Web3. Yeah, so like you mentioned, I'm the founder of M31 Capital. We've been investors in the crypto asset space exclusively for the last couple of years, but we focus specifically on two subsectors within the crypto space, and that's DeFi and Web3. And our kind of mental framework for this is that DeFi is decentralized finance, basically represents a decentralized Wall Street. The suite of products re-architecting, financial products and services on a blockchain for all the advantages that comes with, and Web3, which is basically a decentralized Silicon Valley. That's sort of how we think about things. So products re-architecting sort of core internet infrastructure all the way up to consumer-facing applications on blockchain technology for, again, all the advantages that comes with that we can talk about. So we've always been a DeFi and Web3 fund, and we focused, specifically on those sectors as the space has ballooned into, hundreds of thousands of crypto assets. So it can be completely overwhelming if you try to cover the entire crypto market, moves so fast. But we stayed narrowly focused on those two sectors. And then, you mentioned my co-founder, Michael Swenson, who comes with kind of a multi-decade background and experience on Wall Street. So when I met him, he was COO at Bridgewater, and I was lucky that he was equally excited about the crypto space as I was. So sort of pitched him on coming on board and as co-founder of M31, and what we set out to do was build an institutional grade investment firm dedicated to crypto native investing and supporting the growth and maturity of the crypto.
And just really quickly, how much of M31 right now is invested in sort of like private assets versus liquid tokens? Is it split, or is it one or the other?
Yeah, so that was all sort of to say we have two products. We have the DeFi Opportunity Fund that focuses on the DeFi sector and capturing that opportunity. And then the recently launched, we just announced last week, the launch of our DeFi Opportunity Fund, This is a $100 million fund to invest in the future of the internet. So infrastructure and application layer assets in Web3. So those are the two products that we have. And then both are focused entirely on liquid assets, liquid tokens. So we've got, liquid token exposure in the DeFi fund as well as the Web3 fund. We don't touch equity, public or private, except through a separate vehicle, M31 Ventures, that is just co-investment opportunities we offer to our existing LPs.
Very interesting. So let's kind of talk, let's like zoom out a little bit, just to kind of get your thoughts on the, this broader shift. These people are calling for a shift between a world that's, built around centralized models, companies that have management teams that, typically, accrue value from customers, as opposed to kind of sharing value with customers or users, if you will, depending upon the type of business it might be. Is that something that you think a lot about? I know you talk a lot about the attention economy versus the ownership and the ownership economy. I don't know if you want to maybe touch on some of your philosophical takes on just where internet business models are headed.
Yeah, definitely. I think it leads directly into our thesis around Web3, which stems from this new economic model on the internet, which is the ownership economy. And so I don't want to kind of back up and give like a 3-decade history on the evolution of the internet, but basically we went through 3 distinct phases: Web 1, which Web 1, Web 2, Web 3, right? So the way that we kind of try to prevent Web 3 from becoming just purely a buzzword is by giving it a pretty clear definition. And so we think about each phase of the internet, Web 1, Web 2, Web 3, as distinctly defined by the economic models that were dominant at the time. So Web 1, kind of infamously had, no commerce. It had no native internet currency. Bitcoin didn't exist at the time. It didn't have native payments infrastructure or anything. So people weren't doing commerce over the Web 1 era of the internet. So sort of Web 2 came along, and a lot of these products and platforms figured out, well, if we can't directly monetize internet activity, maybe we could indirectly monetize it, by selling to the advertisers and providing a free product to the customers. And so that was great in a way, because it made the internet, a lot simpler and easier to use, and it onboarded like 4 billion people into this incredible, internet technology. But it came with all these toxic kind of downstream consequences, right? So by selling our data to advertisers, it kind of incentivized. It incentivized, quantity over quality in a way. And so it gave rise to things like, fake news and addictive algorithms and clickbait headlines and all of these sort of toxic things about that we don't love about the internet today. So where Web3 kind of steps in is Web3 sort of tries to marry like the best of both worlds, like returning us back to the original Web 1 founding principles of decentralization and privacy and open source protocols and everything, without sacrificing the usability and the user friendliness of kind of the Web 2 era, right? So Web 1 gets called kind of the read-only web. Web 2 was sort of the read-write web, where we moved from static internet pages to not just consuming content, but also producing content. So the rise of YouTube and TikTok and Twitter and everything. And now Web 3 adds this new dimension of ownership. So read, write, own is kind of the proxy for this new era. And that ownership piece is what leads us to the ownership economy, where users can actually, for the first time, capture the economic value that they're creating online, rather than doing all the work and having all that value accrue to a small number of centralized tech platforms.
So of all of the projects out there right now that are built around a decentralized model where the users of the platform effectively own the economics of the platform, which one would you say is closest to really making a dent into the traditional Web 2.0 monopoly, if you will?
Yeah, great question. This is kind of why we timed the launch of the Web3 fund. We waited until now to separate it from other corners of the crypto space. Because up until this point, all of the winners of the Web3 sector have been kind of this boring, unsexy internet plumbing stuff, right? It's like wireless decentralized wireless networking or decentralized video transcoding or decentralized file storage protocols, like all the important but kind of invisible and unsexy stuff that makes the internet run. So that led to winners like Helium and LivePeer and Filecoin, some of the ones you mentioned at the beginning, that built kind of the core, the foundation of, I think, the consumer-facing side of Web3. And so now, essentially, now that a lot of those like core infrastructure protocols have matured to the point where consumer-facing applications can get built on top, we're starting to see this kind of, it's too early to call it a Cambrian explosion of decentralized consumer-facing applications, but there are a ton of interesting projects that are now building on top of protocols like LivePeer and Filecoin and Helium and everything. So it's definitely early days, and there are a couple examples, but Audius, for example, is a decentralized Spotify. We have Drive, which is a decentralized Uber. We have Huddle, one of my favorite protocols in the space, is a decentralized Zoom. So we could have done this call, for example, over Huddle, and it's a completely decentralized, like very easy to use, cheaper than Zoom video conferencing platform, except that it's built entirely on decentralized infrastructure. So it's built on top of LivePeer for decentralized video transcoding, and it's built on top of Filecoin IPFS for decentralized recording storage. So like we're doing now, recording this. So this is what gets us excited about the Web3 space, this transition now from kind of Web3 infrastructure to consumer-facing applications that are like end-to-end decentralized.
So that's really interesting. Let's start with the infrastructure. Like, where are we? I mean, if you were to sort of use the baseball inning metaphor here, like where are we in terms of infrastructure? Like I always feel, and just full disclosure, I'm on the board of Gemini, so I do get to, get a lot. I mean, I get some degree of exposure to a lot of the new stuff that gets put out there, and certainly things that are traded. We see all that activity on the exchange, but like, where are we in terms of just that base layer of just, I don't know, the operating system of all of this? And in my head, over the last couple of years, Ethereum has been sort of like an important piece of the puzzle. Although now there are alternatives, Solana being one of them, and there are others as well. But like, it doesn't seem clear to me that there's a settled winner quite yet in terms of, like that layer one protocol that settles all transactions and truly is sort of the standard de facto plumbing for Web3. But I'd be curious to hear your thoughts on that. It still seems like different Web3 applications are choosing different platforms. There's not really much consensus there, but is there? I don't know. You tell me.
Yeah. So kind of the question in the space is generally like, are we going to live in a kind of one chain to rule them all future, or in this multi-chain future, right? Is everything ultimately going to get built on Ethereum, or are we going to live in a future with Ethereum and Solana and Cardano and Tron and all these different blockchains? And I think, we've definitely settled on the side of a multi-chain future. And I think this is clearly where the market is going, because part of the reason is ideological and then part of it is practical. So the ideological component is it doesn't really help us promote the virtues of decentralization if we concentrate everything onto one chain, right? So even if that chain is Bitcoin, if we have all of DeFi built on Bitcoin, all of our financial services built on Bitcoin, and all of our tech products and applications built on Bitcoin, that's an incredible amount of concentration where it's not a single chain, whether it's Bitcoin or Ethereum or any other chain. And then second is just pragmatic. Like these chains are optimizing for different things. So some of them are optimizing for security, like in Bitcoin's case. Some of them are optimizing for high throughput or speed or scalability, like in the case of the L2s or things like high performance chains like Solana. So I think what you're going to start seeing happen is each of the, if we're just talking about L1s, each one of them is going to start to have to carve out a niche focus. So someone's going to claim turf as the L1 for gaming, and someone else will claim turf as the L1 for NFTs or something like this.
So like you don't foresee like an oligopoly setup, kind of like with iOS and Android. Like I mean, it sounds like you're calling for maybe it's a half a dozen or more of these.
Yeah, maybe 5 to 10. I would say that's kind of the future that I envision. But that's not really the L1s. I don't think of as the infrastructure really of what I was mentioning earlier. So things like if we want to build a decentralized internet, which is sort of the direction that Web3 is gunning, you need kind of that core internet infrastructure to be decentralized. So decentralized compute and decentralized bandwidth provisioning and decentralized video transcoding, like all that stuff that happens under the hood, you need to be fully decentralized before you can build the fun stuff, a decentralized Facebook or decentralized Twitter. And there are examples of this. We already have, things like Farcaster and Diamond App and DeSo, decentralized social applications, and things like that. So all of these are early stage. So to answer kind of the inning question, I think we're like, walking up to the home plate or something. Maybe we're sitting in
we're not even at the top of the first.
Haven't even started. Yeah.
Yeah. So, I mean, which kind of makes me wonder, like, how much of this stuff can really take off if Bitcoin and Ethereum, like these are the two, I guess, OG blockchains, if those aren't performing well, and what does that mean? Like, I mean, I think practically speaking, if they're not like appreciating in price, because there seems to be a very significant correlation between the number of people who have like a position in some of these downstream tokens with the relative value of their Bitcoin and Ethereum holdings. Like, meaning if you've lost, 80% of your crypto assets because you were long Ethereum at 4,000 and change, are you going to have an appetite to experiment with Helium? Like, maybe not, So do you think about kind of like the big protocols and how they affect kind of your investment thesis with, with DeFi and Web3?
I think the kind of structural difference between this downturn and everyone prior, and we've been through every cycle so far. The fundamental difference is that this time no one is saying, crypto is a failed experiment. It's going to zero. This time people are saying like, oh, maybe I'll get a chance to buy 10% lower. But the overarching assumption is that this stuff is here to stay. Crypto is here to stay. Web3 is just in the early innings, and it's got a whole long life ahead of it. So that's different. If you look at every prior cycle, what you saw is in the run-ups, you saw price, go parabolic and completely unsupported by fundamentals. So it was not supported by user growth or activity or anything like this. And so it had these natural like 90% drawdown corrections. This time it's completely the opposite, So like during we never got sort of the parabolic blow off top that kind of characterizes like previous, bull market peaks. And now, but yet still prices have come down despite the fact that user activity is on the rise. So these protocols have never been more demanded or more used. We're seeing network activity hit all-time highs for a lot of these protocols. Like LivePeer has had 6 consecutive quarters of all-time high network activity and usage, and yet price is coming down at that. So that's sort of exactly what you want to see as an investor, right? Price coming down and fundamental growth and usage and activity and even revenue growth. Not for everything, but for a lot of important protocols hitting all-time highs every single day. That's a great setup as an investor. So kind of to answer the question, I think what it takes is, I don't think a lot of people will look at the strength of the L1s as the determining factor of whether or not to use some of the consumer-facing applications. I think they'll just say, is this solving a problem I have, right? And maybe it's using blockchain tech under the hood invisibly. But that's the exciting part of where we are with the application layer assets in Web3, is that things like Huddle, the decentralized Zoom protocol I mentioned, you would never know that they're using LivePeer or Filecoin under the hood. You just use it because it's cheaper than Zoom and it's better than Zoom. It's got higher performance and then a whole host of Web3 native functionalities that just make it more fun to use. So I think let's talk
about Huddle, because personally I think most people, when it comes to an application, don't care about plumbing and infrastructure, and like for most people it just doesn't work. And does it solve a problem, as you're saying? So with Huddle, tell me about the project. I'm curious to hear kind of a little bit more about the team behind it. You mentioned revenues earlier. Does it produce revenues, and if so, can you speak to the order of magnitude? Can you quantify that? Just to give everyone a sense of, how do you value some of these new initiatives? You know, how do you know, what are the fundamental metrics you care about when you're looking at a project like that? Or I mean, I don't know if you'd call it a business or maybe just a Web3 token is the best way to think about it. But how do you value this sort of this kind of asset?
Yeah, so I think there's kind of two parts to that question. One is huddle and how it functions, how it works, and the interesting things about it. And then the second is kind of valuing crypto assets. So I'll sort of try to break it out there. But yeah, huddle is an incredible project that couldn't have been built until progress had been made on the underlying infrastructure like LivePeer and Filecoin, right? So this is why now is a great time for the application layer of Web3, like I was talking about, because it couldn't have been built before the infrastructure. So Huddle is a team out of India that is completely unrelated to either of those protocols, LivePeer or Filecoin. But because these things are open source and composable and anyone can build on top of them, they built a project on a protocol on top of LivePeer. So they leverage LivePeer for video transcoding, it's a video conferencing solution. So video is pretty important, and Filecoin for recording. But the cool thing about it is that it's integrated not just into, like you said, people don't care about the back end stuff, but they do care about, like, is this solving a problem? So the fact that Huddle is cheaper than Zoom makes it very interesting for companies. I think one of our theses here is basically like we're in a very inflationary period right now. So everyone's looking for costs to cut, and they're going a little further out on the open-mindedness side, thinking what tools can I use to get the same service at a lower price point? And so Web3 steps in to fill that gap perfectly, because there's no centralized party that's taking fees. It's just a kind of a protocol that matches the supply side of it.
So this will sound kind of dumb, but like for the team behind Huddle, first of all, who is the team behind Huddle? How many people are we talking about? How are they getting paid and compensated to do their work?
Yeah, so in Huddle's case, they haven't launched a token yet. So they're raising, generally these protocols will raise a SAFT, a simple agreement for a future token. And so they sort of raise almost like an equity round and then distribute tokens later. And what you want to see is those tokens have some sort of demand within the ecosystem. So you need the token in order to participate in the economy in some way. And so generally they raise via SAFT. And then they hold tokens after getting issued. And what M31 will do a lot of times is we help them through that process. So we're a venture capital firm at the end of the day, investing in early stage technology projects, and then we take them from an early stage, and then we scale them up, through everything from getting listed on an exchange, from their token generation event, TGE, and everything. So Huddle right now doesn't have a token; they just have the platform right now that it's sort of in demo, and you can go test it out at huddle01.com. But eventually,
so are they working kind of with the understanding that at some point in the future they're going to receive a certain number of tokens that are essentially backstopped by like a couple of VCs? Like I guess I'm trying, like they're not.
Yeah, typically the team will have like 15, like maybe 15 or 20% of the token supply or something, and they'll go out and they'll raise from token only VCs like M31 or whatever, and then we'll help them get listed, and they have sort of their liquidity event or whatever when they get listed. So it takes different forms, because sometimes in the case of like Helium, for example, rather than a centralized team, there's sort of like a labs program to the side of it, like it's separately funded, maybe purely through equity or something, and then that gives the team and the developers the ability to work on the project without kind of warping the incentives of the other token holders. So it kind of takes different forms. There's no set standard for this yet.
Are you guys involved at the absolute earliest stage for a lot of these projects?
Yeah, so it's a huge variety. I would say we're generally stage agnostic, but we do get involved with the developer ecosystems, with a lot of the university blockchain groups, a lot of the hackathon operators and the labs programs and everything, to take, they generally take the developers from idea stage to token launch, and then once it's a token, we can sort of pick them up from there and help them scale, like we did for Helium and others. So we're not strictly pre-token launch investors. We're stage agnostic, and then we generally we'll look at early stage things all the way up to, because some of these things in the portfolio, like Live Peer and Helium are, at this point, they're multi-billion-dollar protocols. Like we helped scale them up from, a $5 million valuation to a $5 billion valuation. And then now suddenly we have something in our portfolio that would qualify for like a Series Z round if it were equity, So it's really all over the map.
What's been your most successful investment to date?
Percentage-wise, Thorchain. On the DeFi side of the portfolio. Sorry, I'm getting crazy feedback from my end. But we invested in Thorchain about 1.1 cent, and we took it up to about $20. Position, but we still have a lot of it. We love the project.
Awesome. Nathan, can you hear me clearly? I just want to make sure your internet's...
Yeah, I'm getting feedback from myself. Can you hear me?
I can hear you now, but before I was getting kind of a tinny version of yourself. But I heard you mentioned Thorchain being your best investment. And say that again. You took it from a few cents to how much? What was the...
Yeah. So we took it from like 1.1 cents to over $20. We sold a good chunk of the position. That was one that we got involved in at an extremely early stage. Helium was another massive performer for us too. We got involved at a very early stage with Helium, and then we helped them get listed exchanges and everything.
So one of the metrics that traditional Web3 investors look at is MAUs, DAUs, like a lot of these are sort of obvious, like metrics that really speak to the engagement of a particular ecosystem. Do you have any, can you give us some data on like what the sort of relative size is of some of these top tier blue chip Web3 applications? And I don't know if Audius might be an interesting one, just to kind of give a sense of the relative scale. If you look at a Spotify versus like what, are they like even a fraction of what Spotify? I'm just curious what the sort of size is here, and also not just that, but how is it tracking? If you can kind of speak to growth and how these platforms are growing, on an annual basis, that'd be useful.
Yeah, so maybe to back up to the question about valuing these assets too, I think a lot of people get confused because by looking just at the layer ones, looking at Bitcoin, it doesn't spit out any cash flow or anything. So people say, how do you value this thing and whatever. And I'd say that's largely true for the L1s, which is why they become quite difficult to value, because for a couple of reasons. They could all potentially be the next Ethereum. So like there's an infinity % upside on these for when valuations get irrational. But at the application layer, a lot of these things are generating cash flow. So people are paying to use these protocols, and so that's cash flow, that's revenue to the protocol. So you can, a lot of times, especially in the DeFi sector, for DeFi applications and increasingly with Web3 applications, you can value these things off of fairly traditional valuation methodologies. You can run a DCF on pretty much anything in the DeFi space that is revenue generating. So for example, like Uniswap is the top AMM or the top automated market maker, decentralized exchange, where you can swap one asset for another asset. So you go there and you swap one asset for another asset and you pay a transaction fee. And then that transaction fee is, income to the protocol or revenue for the protocol. Where it separates from TradFi or traditional finance is the fact that all of this is completely transparent and all the information is publicly available on chain. So now you can go and you can follow that flow of that fund, those funds in real time. You can see where that transaction fee is going. Where does it accrue? Who actually benefits from that transaction fee? Kind of to make a long story short, there are only two places fundamentally where where value accrues, and it's either to the supply side participants, basically those who are taking the other side of the trade or providing liquidity, enabling the transaction to happen, or it accrues to the token holders. It'll flow to those who are holding the token in the form of a dividend or something. And so the important thing is looking on chain, looking at the blockchain itself, and with all the transparency and data availability that it offers, you can see exactly where the funds are accruing, and then you can make investment decisions off of that. So there are certain protocols where none of the value accrues to the token holder. So you don't actually want to hold the token, but you might want to participate in the protocol and earn earn that income. And then maybe it has a competitor where the fee is split with token holders that make it more attractive to hold the token versus participating on the supply side. So this is sort of, on one hand, you can use fairly traditional valuation metrics and methodologies, price to sales, price to earnings, run a DCF on a lot of things to value these things. And then where it differs is the transparency enabled by blockchain that allows you to take a more crypto native or get more crypto native insights into when to invest, whether to invest, where to invest.
So when you do that DCF across what's in your portfolio, where do you see the biggest disconnect? Like where do you see the biggest dislocation between intrinsic value based on your DCF work, your projections, and where a certain token might trade, on the markets?
Everywhere. Everywhere. Markets are completely irrational all the time. I mean, almost no one is looking at fundamentals in the crypto space or valuing these things off of conventional frameworks. So I'd say it's a good proxy. It's a good metric to look at, but you can't go 100% off it because your price target for the thing or your what you think the token should be worth won't stop it from blowing 10x or 100x past that price point. But then it works the same way in the other direction, right? People get excessively bullish and you get these like completely unjustified valuations based on fundamentals for almost every project. And then it works like what we're seeing now on the reverse side. People get unjustifiably bearish. And so there are protocols that sell off aggressively despite the fact that they have improving fundamentals and network metrics and growth in users and revenue and everything. So there are projects out there that are they're trading at a $20 million market cap, but they have $40 million of stable coins held in token treasury. So the token holders can at any point vote for a token holder distribution and get that automatic 2x. So the market, that's kind of to say the market goes irrational in both directions. And I think right now what we're seeing is an excessively oversold market for a lot of assets based on the fact that they.
So do you, as like a bigger shareholder in some of these tokens, like have an activist element of your strategy where you will push for some vote that'll sort of unlock value that you think is being unrecognized by the markets? Does that happen?
Exactly. I think activist is kind of a loaded term. Some are reluctant to call themselves that, but our strategy is active network participation. This is what we talk about, and this is kind of the crypto native element of investing in the space. Sort of because of the fact that a lot of these protocols, like when they're truly decentralized, they don't have a team or a CEO or board of directors or employees to allocate resources. They just have a token incentive structure that gets anyone in the world, any user or anyone to participate in the protocol and then earn an ownership stake in the protocol. So this is obviously the case with Bitcoin, where anyone in the world can get up and hashing and earn into an ownership position in BTC. So I think part of what you need to do, like what's necessary to do as a crypto native investor, is participate on chain in these protocols through mining or staking or running nodes or liquidity providing or liquidity directing or any of these crypto native investment approaches, including governance proposals like what you were sort of alluding to help guide and support the direction of a lot of these protocols. And this is largely what we do at M31.
How concentrated is your book?
Fairly. So this is also sort of what separates us from a lot of other crypto native funds. Most will take this sort of spray and pray approach because during a bull market, everyone's
spray and pray. I like it. Yeah.
You just write small checks into everything and then hope that one thing is like a fund returner. It's not the approach that we decided to take. So we run a fairly concentrated book, so about 10 to 20 assets in the portfolio at any time. And the reason is we take kind of a 3-part approach to investing, where we're thesis driven. So we've got a clear thesis on the DeFi sector and a clear thesis on the Web3 sector. And then we're, part 2, picking who we think are going to be the category leaders within each of those subsectors within DeFi and Web3. And then most will stop there, but we take it a step further and actively participate on chain. So we are running nodes for everything that we invest in. We're active participants on chain. We're lending into the lending markets that we invest in. we're trading almost we're not an actively traded fund, but when we make decisions, we execute them over decentralized exchanges rather than centralized exchanges to maintain that crypto native approach and support the protocols that we're investing in. So it's really a range of strategies, but this is what makes the crypto space more fun, more exciting, and more interesting to invest in. Because rather than sort of this binary decision between do I buy the asset or do I sell the asset, you have this third new tool in your investor toolkit, which is, can I earn the asset, right? Can I contribute resources to the protocol where I can earn additional tokens without contributing additional capital? So like with Helium, for example, we were some of the first hotspots set up anywhere in the world, and we've been earning new HNT tokens every single day for the last 2.5 years without putting additional capital to work. And so there are really interesting kind of crypto native investment strategies like that we look to deploy.
So they're somewhere between, I think, 5 and 10,000, maybe 10,000 hedge funds out there, and most of them are focused on, the vast majority are focused on traditional asset classes. How many institutional grade crypto funds exist, at least in the US? I mean, I'm just curious if you have any sense of just how many folks you compete with that are, professional, not just like individual dudes on Coinbase, whatever, but serious kind of firms.
It's it's just anecdotal from the sense I get being in the market, but there's really a handful. So I would say the upper end of it, institutional grade investment firms in the crypto space is maybe 10. And then out of those 10, how many of them are incorporating any kind of crypto native investment strategy, as opposed to just getting exposure to Bitcoin or having exposure to the upside of price appreciation of the token without kind of any on-chain network participation activities? I would say then it shrinks to 3, 4, 5, on the order of that. It's very small.
Yeah, you guys are really on the frontier here as far as I guess the asset management aspect of this. And I think it's cool that you guys stake as well. I'm assuming you stake everything you can.
Yeah, absolutely.
Just to reduce or to improve your total return. That's really fascinating. So as far as do you have like right now a kind of a favorite position that you'd want to talk about? Just is there one name you just need to feel the need to pound the tables on that you feel the markets just completely don't understand, or where you find the biggest discrepancy between let's say future worth and current price?
Let's see. I think
that's also somewhat liquid, that people can actually purchase if they without having to set up access to an exchange in China or something.
So maybe before I get into specific names, I'd say the thing that I'm like overarchingly bullish on is kind of rewiring the definition of Web3, or getting people's mindsets away from thinking of Web3 as just overpriced JPEGs or pixelated rock images selling for $10 million, or art and gaming applications. I think Web3 kind of it reminds me so much of the early Bitcoin days, where Bitcoin was seen as both. It was this weird thing where it was seen as both frivolous and subversive, right? So on one hand, people saw these like goofy Chuck E. Cheese tokens on the internet that they thought was just a passing fad or whatever. But then other people, the other half, saw a technology for the disruption of the nation state and a new monetary order. So it was both of those things at the same time. It was frivolous and subversive. And I think Web3 is kind of in that same position right now, where a lot of people look at the Web3, what Web3 has to offer today, and they see art and gaming, and they see a metaverse with no users, and they see clip art selling for millions, and they kind of write it off, just like they wrote off the early internet because it didn't have any commerce on it. They wrote off Bitcoin at the beginning because it just looked like a toy. I think a lot of people are misconstruing Web3 as only useful for things like overpriced art. The way we look at it, though, is we look at the underlying technology and we see an anti-authoritarian technology. This stuff is truly incredible, and a technology with the optimistic possibility of protecting, classically liberal Western values online, like free speech and privacy and the respect for private property and individual sovereignty and everything. So, some of the things that are getting the most use today, some of the Web3 protocols that are seeing the most amount of usage today are being used in Ukraine right now. So, right now war is all cyber, it's all digital at this point. Russia's first attack was basically shutting off Ukraine's internet infrastructure so that they couldn't access life-saving information and contact their family members and everything. And so what did the Ukrainians do? Well, a lot of them onboarded into a protocol called DVPN is the ticker. It's called Sentinel. It's a decentralized VPN network that secures censorship-resistant access to the free and open global internet. And so every single month now since the war broke out, Sentinel has hit an all-time high network activity because it's actually solving a real problem, and it's an example of Web3 tech focused on these anti-authoritarian use cases rather than these kind of frivolous, NFT kind of things, which are fun and amazing, but they're just not fundamentally as necessary as some of the anti-authoritarian Web3 tech that's getting used today. And there are more examples of this with Filecoin and LivePeer, Filecoin and Arweave being used to fight fake news and the propaganda campaigns and to preserve Ukraine's cultural history so that can't be erased from the history books and everything. So we're very bullish on that side of the Web3 stack and kind of rewiring the narrative around Web3 to focus on some of those more real world tangible use cases.
Is Sentinel a messaging app?
It's a VPN network. So it's a decentralized VPN.
Oh.
VPNs, typically people think of VPNs as being used exclusively for privacy, but they're actually largely used for access. So if you're behind the Chinese firewall, you use a VPN just to access the global internet, and that's exactly what Ukraine is doing. And so it again underscores the idea that Web2 technology is centralized and it's censorship prone and it's closed source technology, and it's susceptible and vulnerable to attack from Putin or from whoever. And what we need actually is resilient, anti-fragile, decentralized, open source protocols, because that's how you build an internet that is resilient and and supports human rights and everything.
What's your take on Gary Gensler at the SEC?
I mean, people have talked about this. He obviously, he knows a lot about blockchain technology. He taught a course at MIT on blockchain tech and was extremely bullish Bitcoin and blockchain technology while he was teaching this course, and then he completely changed his tune as soon as he stepped into public office. So I think that's kind of typical. I think there's a lot of internal pressures that you face once you're kind of on the other side of the table. I probably won't say more on that without speculating, without being purely speculative. But I will say it's a positive step that we have someone in office who at least understands the technology. That's a step forward.
But as far as like maybe concrete regulatory steps or regulatory action, do you feel like it's like under a Gensler regime, is that ultimately beneficial to the industry, or is it too heavy-handed?
I think overarchingly they're going to go after bad actors, right? That's the thing. They're going to be pro innovation and anti con artists, and that's what you want to see. That's where you want to see regulation heading. You want to see them throw the baby out with the bathwater. So, a lot of the comments that the White House has been coming out with recently have been around maintaining America's technological leadership in the world, and speaking specifically on things like stablecoins and Web3 technologies and everything. So I think they ultimately, as they get up the learning curve, as you understand this technology, you can't help but become bullish this technology. And I think so the more people we have in the White House and in office who understand the tech, the more we're going to see this kind of approach of pro innovation and anti bad actors. So I don't think there's any risk whatsoever that the White House comes out with some overarching blanket ban on crypto or Web3. And then the other way to look at this as well is Web3 is non-financial, pure technology applications. So things like Filecoin, that's a decentralized file storage network. It's much harder to go after that as a regulator than it is to go after something that claims to want to overthrow the US dollar, for example, right? That's a little easier to go after. So I think these tech pure plays, they have regulatory support in the sense that every country on earth wants to be the tech leader of the universe.
Yeah.
And then also these things are just harder to ban when you're talking about a decentralized Zoom or a decentralized Twitter or a decentralized Facebook, right? It's a lot harder. You'd have to make the antitrust case as a politician.
What about the argument that, or the risk of, certain tokens being labeled securities? How much of that plays into your capital allocation and just thinking about valuation?
So there's nothing wrong with being a security, right? Like we have an incredibly robust securities market and everything. I think a lot of what our industry is clamoring for is clear regulation. What we want to get away from is the uncertainty around what is and what is not, and like, so what all you can do as an industry is kind of cautiously step forward, cautiously step forward, knowing that you're supporting, the right things in the space, things that you want to see exist in the world, positive technological changes and all of this, and then know that you'll be on the right side of history and the right side of the law. But if even everything we invested in became labeled a security, then we would just be, a venture capital firm investing in, revolutionary technology securities.
So let's touch on DeFi as well, because that's obviously a big part of your efforts. What's sort of exciting in DeFi today? How should investors be thinking about, differentiating between different DeFi protocols? And I don't know which are maybe the most popular today, but it seems like Aave has been around for quite some time and achieved a certain degree of notoriety. I don't know too much about its actual, let's say, overall engagement levels, but then of course there are others. So I'm just curious what, which ones you think are most promising, and kind of your broader take on where DeFi is heading.
Okay, I'll do the reverse of last time. I'll start with specific protocols and then I'm back into kind of the general overview. But Thorchain is one of our favorites, one of my personal favorites in the space. Thorchain is a cross-chain DEX, a cross-chain decentralized exchange. So today, if you want to swap one asset for another asset, you go to Gemini or Coinbase or wherever, and you swap asset A for asset B. But you have to go to a centralized third party, some centralized platform, or you can go to a decentralized exchange like Uniswap or SushiSwap, but those restrict you to a single chain. So you can only exchange one Ethereum-based asset for another Ethereum-based asset. So you get the benefits of decentralization and self-sovereignty because you own the assets and the private keys, but you kind of lose the flexibility that you have on Gemini and everywhere else. So Thorchain is exciting because it's the first cross-chain decentralized exchange. So you control your private keys the entire time, but you can finally swap real Bitcoin for real Ethereum without going to a centralized third party. So that's an incredible, tech improvement for the overall crypto space. And then if we back up kind of more broadly on DeFi, we're talking about kind of, so far we've seen a one-to-one mapping of traditional finance. So, borrowing and lending protocols like Aave, spot trading, decentralized derivatives trading, fixed income, insurance. So these are sort of the subcategories of the DeFi sector. And then, like I mentioned earlier, what we do is sort of pick the category leaders within each of those subsectors. So on the spot trading side, we're very interested in Thorchain at the moment. And I think specifically right now, what's happened is there's kind of this progression in the crypto space because it moves so fast. Everything's open source, and there's permissionless innovations. People just build things on top of existing apps and everything. You go through these like rapid fire iterative cycles. So it starts with kind of an invention, and then there's like rampant experimentation and then consolidation. And so what we saw last year was insane amount of experimentation. So this Cambrian explosion with new projects and experiments in the DeFi space. And we moved into DeFi 2.0 and tried to move on into other really interesting use cases of DeFi. And I think what you're seeing now is a consolidation sort of back to a lot of the OG or the blue chip protocols in the DeFi space. So a lot of attention is returning to what works. and that's Aave and Uniswap and some of the core DeFi primitives that, like you said, have been around for a while as far as the crypto space is concerned, but in reality, they're really brand new protocols that this was their first cycle getting battle tested, and they worked, and they came out flawlessly out the other side despite all the market chaos, and so people are realizing, all right, these are the protocol primitives that you want to build new DeFi applications on top of.
Yeah, I think that's fair. And then on NFTs, you kind of referenced them earlier, but what would you say is sort of the next iteration of NFTs that's not going to be just a gimmick, but something that will actually scale and be relevant to, you know, a larger portion of the crypto participation sort of industry as a whole? Like right now, I just feel like it is turning into fodder for like just funny headlines and memes, but not really being taken that seriously. So I'm just curious, like, what is that next version of NFT technology look like?
Yeah, I would say overall, I'm extremely bullish NFTs and extremely bearish their current iteration, like the current format of NFTs, because I think we haven't even begun to scratch the surface of interesting applications and use cases for non-fungible token tech, right? So like I've been talking about, a lot of what people think is just, you know, the things that you're making fun of, right? Like art and overpriced JPEGs and you know, gaming applications and whatever. But NFTs are really just blockchain-based property rights over digital assets, right? So Bitcoin, sort of the technological breakthrough is Bitcoin gave us blockchain-based property rights over one particular kind of digital asset, and that was money. And now what Web3 is doing is expanding those blockchain-based property rights to all other types of digital assets. That's, you know, domain names, that's your data that you're producing, that's your tweets and your blog posts and your music files, your photos and patents and, you know, royalties and intellectual property. So every type of digital asset can be tokenized now and benefited from the blockchain, the property rights that you get for building them on chain. So right now we're just hitting the low hanging fruit of, you know, art. Basically, here's an image file, and you can actually own it and monetize it, sell it to someone. But I think where we go next is we start exploring all of the other types of digital assets in tokenized form. So, you know, Audio is basically a decentralized Spotify, allows musicians to own the things that they create, the songs they create, and then with that ownership comes the ability to monetize it directly if they want. So they can sell, you know, directly to their audience. They can figure out how to monetize their music or that fan engagement if they want. There are platforms like Mirror, it's a decentralized Substack or publishing platform where a journalist or anyone can create a blog post or an article. That article gets turned into an NFT, conferring ownership. Like, this author wrote this article, and because they own it, they can take it wherever they want. So it's censorship resistant. They can't be deplatformed. They can move to another platform if they want, and importantly, they can monetize it. So they could mint, you know, 10,000 versions of that article and then sell it to individuals for $1 each. So instead of one lump sum subscription payment on the New York Times once a year, you can pay, you know, per article. You can pay $1 per article, or even more interestingly, they could do things like pay per scroll. So if the article costs $1 to read, people connect via MetaMask and they scroll through half the article, they pay 50 cents, and that 50 cents goes, 100% of it goes to the author or the blogger or the journalist. So you're going to see, I think, a lot more of these types of ownership economy, you know, brand new types of economic interactions enabled by the ownership economy.
So, I mean, we've talked about kind of decentralized exchanges, you know, decentralized Spotify. You referenced a decentralized Twitter. I mean, do you foresee a future where Web3 and Web 2.0 coexist, where you have your Amazon, you know, AWS, but you also have Filecoin, and that both are somewhat equally popular? Or do you genuinely believe that you know, Web3 will just overtake Web2 and you know, companies like, say, Coinbase are just outright replaced by something like a Uniswap?
Yeah, well, that's an interesting example because Uniswap actually just overtook Coinbase in terms of trade volume recently, and they've kept up this as far as I've seen ever since. So Uniswap is a completely code-based exchange. They have 0 employees, and they now process more trade volume than Coinbase. So I think this is just an interesting example, and we're going to see more of those. But then as far as kind of the transition from Web 2 to Web 3. Yeah, it's going to be messy. There's going to be very blurred lines between what is Web 2, what is Web 3. I think you're going to see the emergence of the term Web 2.5, get talked about a lot. You'll start seeing, Web 2 companies using Web 3 technology on the back end, maybe just behind the scenes for cost savings reasons. Netflix just came out recently, right? And they said they're basically becoming unprofitable because of, how much money they're paying, I think AWS, for this stuff. So they could move over to something like LivePeer or Filecoin and dramatically reduce their costs on the back end, but you wouldn't know it as a consumer watching Netflix shows on the front end. So you'll start to see some of that. And then of course, decentralization is a spectrum. So even some of these Web3 protocols they might be Web3 in name only or in varying degrees of decentralized. So I don't think it's going to be one sharp kind of overnight shift from Web 2 to Web 3, but I do think it's an inevitable shift because basically you have these push and pull factors, pushing Web 2 companies into the Web 3 world. Things like inflation, they're looking to to cut costs and all of this. There's also limitations on the scalability of Web 2 tech that can be solved with Web 3 technology. Security concerns, all these kind of things are going to push Web 2 products into the Web 3 space. But then there's this pull factor of there's all these really interesting things that you can do in the Web 3 space, like with Huddle, for example. They have something called token gated meetings. So you can what you could do at SumZero is everyone who's been a member for over a year, you can airdrop a SumZero token, and it doesn't have any value. You can't trade it. You can't do anything with it. But just having that token in your wallet could give you access to meetings on Huddle, webinars like this, that you get exclusive insight into as a SumZero loyalty member or VIP member or something like this. So token gated meetings, something that you can do in the Web3 space that'll get really interesting. You can use your NFT avatars and things like that. So I think there's kind of these push and pull factors that'll make this shift kind of inevitable. And then sort of a flywheel effect where creators will always go where the consumers are, and the consumers will always go wherever they're treated best. And Web3 platforms treat the users better than Web2 platforms because they give them ownership over the platform and ownership over content and ability to share in the profit and everything. And so that'll onboard more creators into that ecosystem. And it'll be, fundamentally impossible for Web2 platforms and companies to compete with Web3 on cost or functionality. So they'll have to, I think, start onboarding onto Web3 protocols, probably on the back end if they want to save the consumer relationship.
Or I would imagine they would just have to build use cases that are not replicable on Web3.
Yep. I think this is the best thing. I think this is the single best thing about crypto is that in order to compete, you have to provide a service that's better for the user, right? So if you want to compete with these things, you either have to cut your costs dramatically, or you have to improve the quality of your product. So either way, for us as the consumers, life is going to get incredible because we'll either see a dramatic cost reduction through the Web3 stack, or we'll see a dramatic improvement in offering and everything from the Web2 stack. So I think we're on the cusp of a Web3 renaissance.
Nathan, I think that's a great way to end and a positive note to end on. Just before we close, what's the best way for folks to reach you in case they want to learn more about M31?
Yeah, very active on Twitter at Nathan Montone or M31 Capital at M31 Capital or directly through our website, M31.capital.
Awesome. Thanks, Nathan. This was really, really interesting. And I feel like we got a good slice of the future here. So looking forward to staying in touch. And thanks again for taking the time to chat with us.
Yeah, thanks so much. Speak soon.
Take care.